Welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Amerisource Bergen Corporation, ticker ABC. Over the next 5 minutes, I will discuss both the valuation of this company and what I think of the business quality. First up, we look at industry. This is in the healthcare providers and services industry, and I need to know a little bit more about what they do. So they source and distribute pharmaceutical products in the United States and internationally. So its segment distributes brand name and generic pharmaceuticals, over-the-counter healthcare products, provides pharmacy management, staffing, and other consulting services, supply management. So this appears to be a pharmacy management company. These tend to be quite good companies from what I recall, but I've not looked at one before, so we're really going to have to dive in to see what these financials tell us about the business. The first thing I see is that the beta of 0.48 is attractive because when it's under 5 like that, under 0.5 like that, it means it's relatively low volatility. A low volatility stock usually means a low volatility business, but we'll have to see. Now, the beginning of this looks attractive. These look pretty stable, but then the end isn't stable. So again, in the early 2000s, you have 7, 8, 8, 4, 8. In terms of returns on capital, 9, 6, and you have 12, 15. So especially in the early 2010s, things look really good. You're in the double-digit returns on invested capital. But beginning in 2014, you drop below that, and things get really unstable. So I don't like what I see for the last 8 years. 7, then they lost money in 15, then they're up to 27%, then you're down to 6, 25, 11, and then you lost money in 2020. You make a lot of money in 2021. So something weird is going on with this business. It's very unpredictable. So I have my concerns with what's going on there. If we just look at the 10-year median returns, this business looks attractive. Median returns of 17% return on equity. I like that number over 15. Return on invested capital of 11.5%. That's good. Passes because it's over 10. And then your valuation ratio seems reasonable. PE of 18. That's a pretty reasonable number. I'd like it to be under 15 when I buy, but that's okay. Now, you have the price to book stands out really high here of 48, but it's likely not a big deal because this is probably a pretty capital-light business, but we can dive into that a little further. You can see that with the returns on equity, and they might have some share buybacks, which is causing this number to be a little wacky. Price to sales of 0.1 is a little weird, but I think it's of how they treat their business, and we can dive into the revenue. I don't like how assets are growing faster than revenue. That's not a great sign, but you have double-digit EPS growth over the last decade, double-digit revenue growth. That looks good. So revenue's gone from $78 billion to $213 billion. That's huge. But really, when you think of the size of business, it's really about the gross profits. And so gross profit's gone from $2.6 billion to $7 billion. And these gross profit margins of 3.4%, 3.2%, that's really what this business is. What they're doing is they're taking credit, I think, for all the revenue of all the pharmaceuticals that they sell and distribute. But really where they get their profits is from these kickbacks from the pharmaceutical companies and from their upcharges from them. So it's really a distribution business. So these revenue numbers don't really tell the story nearly as much as your gross profit numbers, which is the true story of this business. So operating profit, about doubles over the decade. That's okay. Now EPS goes from 280 to 739. The problem is these numbers are not consistent. You have no stability here, and it makes it hard to predict. So whether it's 280 per share, 184, 116, losing money in 15, 632. So and you lost $16 per share in 2020. So what is that? Is that a one-time issue? It's hard to say. Your numbers are really hard to parse here. Income statement. Yeah, so you can see they're buying back shares, and that's what I thought. So you got from 257 million shares outstanding, 208 million shares outstanding. They look like they're pretty regularly buying back shares. I like what I see there. Balance sheet. So debt. So they've grown debt from about $1 billion to $6 billion. How's that compared to the total size of this business? Not that big, maybe 50% of 20% of the business. It's not a hugely leveraged business, and you still have a lot of cash equivalents on there. And you can see they don't really have PP&E. So the current assets is pretty small. And what you're probably doing is with those buybacks, you're really just driving down the shareholders' equity. And so they look at the cash flow statement. So they have some share compensation, which is relatively low compared to their cash from operations, but they're dumping money continuously into buying back shares, and so that's what you see there. So on the plus side, even though you have years with losses, you have 10 straight years of positive cash flow from operations. So that's a really good sign. It means that your losses are kind of like non-cash charges or something like that. So you have acquisitions in 2021 taking place. You have quite a few acquisitions here. So it's not necessarily, let's go back to the income statements to figure out what that is. So yeah, you have other non-operating income. So it's like, it could be like a charge off or something, but you pretty regularly have some stuff here that's quite big. But 2021 was a weird circumstance. So that loss doesn't look like it's on the operating level. And so that's good to see. It's hard to parse. This business could be attractive. What makes it really difficult, though, is I don't know what a stable number is for earnings. And so it's really hard to value this business. Underlying the market, these tend to be relatively good businesses. You see some stability here, and you see it's a huge, huge business. So they probably have a moat. But I have major concerns about the future of this business in terms of quality. I can't predict the earnings, so it makes it almost impossible to value. So despite this number looking attractive, I don't know if that 18 PE is real. And so that's a negative for me on this business. The second thing is, besides the volatility here, you have some major risk that at some point in the future, perhaps the near future, you'll face some negative changes to how pharmacy benefit managers are allowed to charge or have kickbacks or things like that. There's constant talk in the government about changing their ability to charge those fees. And so I don't like the placement of this business. And so for me, it's a pass. If this was more predictable, if I could understand what was going on here, then maybe I would consider it. But there's just so many other companies that are able to be predicted that it's not worth spending time on one where you have such clear volatility in their ability to earn a profit. So like this video, hit that subscribe button and ring the bell so you can get notifications as I upload new videos. Thank you for listening, and until next time, stop paying fees, start building wealth.